This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation. Our goal is to encourage accuracy and accountability to help smaller nonprofits successfully manage and sustain their organizations.
Hello, my name is Shawn Miller. I'm a partner in the DC office of Caliber CPA Group and a member of the Greater Washington Society Nonprofit Financial Accountability Task Force. And today we're going to talk about employee benefit plan basics and how those relate to nonprofits. First of all, what are employee benefit plans? There are multiple types of them. Some of the main ones, obviously there's retirement plans, you have defined benefit plans, you have defined contributions plans. Under those you have subsections of plans. You have 401k plans, 403b plans, 457 plans, all various types of retirement plans. Then you also have health and welfare plans. You can have a defined benefit health and welfare plan. Those are rare, but you do see them. You can have health savings account, flex spending accounts. These are all various types of benefit plans. Today we're going to focus primarily on the retirement plan side of things, since those are the most common, what people have most frequently out there. So just to make sure we have a baseline and everyone understands what we're talking about, what's some terminology related to benefit plans you're going to hear throughout this presentation and in general? The first thing you're going to hear a lot of is called ERISA, the Employee Retirement Income Security Act. And this is the primary law that governs employee benefit plans. It's been around for a number of years, and that's what dictates most of the laws that are followed here. EBSA, so that's the Department of Labor, their sub-agency, the Employee Benefit Security Administration. And they have oversight over benefit plans. So both from an audit side and from enforcing ERISA, that's their responsibility. TPA, that's a third-party administrator. You hear that tossed around a lot. And that's a service provider who handles the plan administration. Typically, you'll see this in a 401k plan situation, whether it be a large brokerage firm like a Fidelity or a Tia Craft, or there's other firms that's all they do is just administer the plan. They'll handle enrollments, payments, eligibility determinations, loans, handle all the administration side of things. So those are three terms that you're going to need to know as you get into the employee benefit plan world. A few other things that you're going to hear: party and interest. That's a phrase that comes up on the Form 5500, which we'll talk about shortly. Essentially, it's a related party or an interested party to the plan. Prohibited transaction. Again, this is something you'll hear, hopefully not very frequently with your own plan, but you will hear. And these are transactions that are prohibited, specifically prohibited by ERISA. They have to be disclosed in the audit and the tax return. If you have these lead to audits. We talked about the EBSA. They look to these. You definitely don't want any prohibited transactions. That being said, you need to know what they are. You need to know where to find them. And when we get to the end of the presentation, there's some links to some good resources, both on the Department of Labor website and on the IRS website. And lastly, vesting. Again, more common in a 401k plan and defined benefit plan. Vesting is the amount of time it takes you to fully earn your benefits. Right? Most people know what this is. You start working somewhere, maybe you need to be there 5 years before you vest in the employer portion of contributions to benefit plans. Again, something you need to know. So what are the different features of different benefit plans? What separates one from the other? Defined benefit plans, very rare. These are the old style pension plans that we've all heard about. There are some industries and some organizations that still have defined benefit plans, but you see them less and less. Participants are guaranteed a fixed amount in retirement payments. So depending on how you select your retirement and how long you select to get these payouts, the company guarantees you're going to get X dollars per month for a certain number of years. No risk to the participant there. You have to have an actuary. So the actuary determines what the contribution is that the company has to make to the plan based on several assumptions, including things such as investment return, which, as we all know, can be all over the place, the amount of time people work, average retirement age, mortality tables, right? So once someone retires, how long are they going to live after that retirement is a factor. So these determinations are just based on a wide array of assumptions that can be all over the place. The key thing to one of these type of plans is this next one. Employers assume all the risk for the investment earnings, right? So you've, as a participant, are guaranteed a certain dollar amount. The employer makes that risk that however much they invest on your behalf is going to get them to be able to pay you out that amount of money. And if the investments don't earn enough, they're going to have to kick in the difference. And for the auditors, there's a lot of financial statement disclosures that are required when you have a defined benefit plan. Actuarial information, the investments of the plan, different assumptions, possibly pages and pages of disclosures. Again, these are rare. You see them less and less than you did 20 years ago or so. So defined contribution plans, much more common. You'll see these, anyone can have one of these, small companies, large companies. 401k plans, 403b plans are the most common. At one point, nonprofits couldn't have 401k plans, so you saw 403b plans much more frequently. Now that 401k plans are acceptable for nonprofits, you'll see that a lot more. But similar in terms of what we're talking about here. They can be contributory or non-contributory, meaning the employer can make a contribution on your behalf to the plan or not. It could be solely where the participant makes contributions. They can have loans to the participants, right? Typically up to a certain dollar amount for certain purposes and with certain eligibility requirements. Again, with that vesting policy, you can take a loan on your 401k plan or 403b plan account. And that's another big difference. So each participant in a defined contribution plan has their own account. You work for an employer, has 50 employees. In that plan, each of those 50 participants is tracked separately. Now, not necessarily their own investment account, but their own record-keeping account. So you know exactly how much they've contributed, what they're invested in, how much they've earned in their account, as opposed to the defined benefit plan where it's just a lump sum pool of money. The biggest advantage to a 401k plan, again, is participants make pre-tax deferral contributions. Right? So we all know how this works. You, out of your paycheck, you make a contribution that then is non-taxable, so you're getting the benefit there. On the flip side, because of that, you assume all the risk for investment earnings. Basically, what you're saying is, I'm going to take my money, I'm going to decide where to invest it in, and hopefully when I get ready to retire, there's going to be enough of a nest egg there to carry me through the rest of my retirement. So much different than the defined benefit plan. Again, why this is much more popular is there's much less risk on the company side and significantly less financial statement disclosures for the auditors in the bunch. Deferred compensation plans, we see these sometimes. A lot of times they're called 457 plans. Again, participants defer a portion of their income on a pre-tax basis. Typically, you'll see this more at your C-level, your executive directors, presidents of organizations, whereas as an incentive and as a bonus, they'll get these deferred compensation plans, allow them, again, to defer an additional piece of their income till the retirement age when, theoretically they'll be paying less in taxes and they'll get that benefit. The thing to know about these 457 plans and deferred compensation plans is technically the assets remain assets of the organization. So you're going to have an asset and a liability on your books for that same number. They're also subject to the claims of the creditors of the organization. From a company standpoint, that probably doesn't have much impact, but from the individual with the deferred compensation plan, that's important to know, because what that means is until you start collecting that money, it's not yours, right? If the entity that offers you this 457 plan goes bankrupt, has some big lawsuit against it, the money that's in that 457 plan could go away in a second. So again, those are the main differences between the plans that are out there. Again, the 401k and the 403b are far and away the most common. So what are some of the financial requirements of an employee benefit plan? All right, you need to know these if you're doing an audit. You also need to know them. Your internal, you're running a nonprofit. Maybe you're a trustee of your company's 401k plan because you're the financial person. So you need to know what it is that you need to do to comply with these regulations. Again, as a trustee, you have the obligation for this compliance. So audits. Do plans need an audit? So essentially the rule is plans with over 100 participants, for the most part, need to have annual audits. And for a number of years, this didn't apply to 403b plans. However, probably about 5 years ago now, this does now apply to 403b plans. So pretty much any plan that you're going to have If you have over 100 participants, you're going to have an annual audit. If you have a plan whose assets are held in a trust, those have to have an audit. And those are all based on the requirements of the Form 5500, which we'll get to in a second. Now, one thing that a lot of defined contribution plans do, and they're allowed to do under the law, is have what's called a limited scope audit. And what this means is that essentially the plan auditor relies on a certification from the trustee for the investment-related amounts on the financial statements. Trustee being the investment custodian, again, a Fidelity, a TIAA-CREF, someone like that, or your bank, whoever is holding the money. And this, again, allows the auditors to really reduce the amount of testing that they need to do on the investments and focus more on the plan activity itself, payments, eligibility, things like that. So again, it reduces the amount of time involved, hopefully reduces the fees, and so on. So it really makes things a little bit easier. What type of tax filings are benefit plans required to have? Again, this is for retirement plans primarily. So benefit plans file what's called a Form 5500, and it gets filed with the IRS, but it also is then shared with the Department of Labor. Excuse me. As we mentioned, the EBSA is under the Department of Labor, so even though the form is filed with the IRS, it then goes over to the Department of Labor. So both groups have access to this information. Again, for plans with over 100 participants, the annual audit must be attached. And unless you have what we talked about earlier with the limited scope audit, you need to have an unqualified opinion attached to your Form 5500. The form's due 7 months after year end, and you do have a 3.5-month extension available. So again, you need to coordinate all this with your auditor. If you are an auditor, you need to coordinate it and make sure you schedule properly. If you're running the nonprofit and on the internal financial side, you need to make sure all this is scheduled and that you know these dates. The financial information on the Form 5500, Schedule H or I, depending on the size of the organization, is really just a small piece of the form itself. You have to list out your balance sheet and your income statement and so on. But there's a lot of other disclosures required. Most notably is what's referred to as Schedule C on this form. You have to list all your service providers who were paid over $5,000, what they were paid for, how much they were paid, if there's a relationship between the plan and the provider. So a lot of information you're going to have to get from your service providers. You need their EIN number, their address. So again, not something that can necessarily be done at the last minute. So you need to make sure you plan that out properly. So also as part of your financial requirements there with the benefit plan, there's other things you're going to need to do. Typically these will be done by a plan administrator, done annually. So you're really not involved too much other than providing data to these. There's discrimination testing and top-heavy testing, which are really geared towards the 401k plans, making sure that the senior executive level people in the plan at the organization aren't benefiting more than everybody else is. So there's testing you have to do there. If you fail, you may have to refund a portion of the contributions. I've never seen it get to a situation where plans get penalized and revoked and get their status revoked and so on. But there is other testing that needs to be done. And again, all these things, when you have a benefit plan, you just need to be aware of and make sure you're on top of all of those. So just to wrap up, some places you can get some additional information, which I would definitely encourage you to look at if you're new to the employee benefit plan world, if you just became a trustee in a plan or you're thinking about implementing a plan at your organization. The Department of Labor has some good websites under the EBSA, one for 403B plans, one for small employers. The Internal Revenue Service has a couple good sites that are related to 401k plans, and then just a frequently asked questions for retirement plans in general. So various places you can go to get some additional information, hopefully answer some questions you may have and lead you down the right path. So again, my name is Shawn Miller. I'm a partner with Caliber CPA Group here in Washington, D.C., and thank you for your time.